Europe's impact venture capital scene has exploded beyond recognition.
There are only 30 to 50 impact VC funds in Europe. Today, that number is 800 to 1,000.
But here's what no one talks about. This massive growth has created a brutal new reality.
All venture capital funds in general, fundraising is difficult.
So what separates the funds that succeed from those that fail? The answer might surprise you.
The team is the entry point and certainly the most important element.
And here's the breakthrough that's changing everything. The myth that impact means sacrificing returns has been shattered.
I do confirm we have systematically or almost systematically a positive correlation between financial performance and impact performance.
But the real game changer? Money talks, but only when impact delivers.
This share will be distributed to you as a fund manager if and only if impact objectives are met.
The future of impact investing is being rewritten with one revolutionary approach.
Asymmetric risk-return profiles in funds could be a relevant and interesting way to catalyze more private funding in funds.
How do you build an impact fund that skeptical private LPs can't resist? Join us as we dive deep with Cyril Gouiffès of the European Investment Fund, the architect behind Europe's most sophisticated impact accountability structures, and the strategies unlocking billions in private capital.
Welcome to the Impact Highlight series by EUVC, Impact VC, and Impact Supporters. I'm your host, Solliv. I'm a former Impact VC and now author of a newsletter and podcast in the Impact VC sphere called Impact Supporters.
And I'm your co-host, Douglas Sloan. I'm an LP investor at Better Society Capital and also co-founder of the Impact VC community. I'm really excited today that we're going to be joined by Cyril Gouiffès of the European Investment Fund. I've known him for many years. He's been a fantastic sounding board as a fellow LP, and he brings a breadth and depth of experience that I think is unparalleled across Europe. Probably written the most investments into European impact venture capital funds by value over the last 10, 15 years.
And if I had to give you 3 reasons why you should listen to this and 3 themes that really stuck out to me, I think was the first one is that Cyril has a lot of experience in this space, and he told us that in 2013 there were only 30 to 50 impact VC funds in Europe. Today that number is 800 to 1,000. So super key interesting fact. The second point is that if we want to get more private LP money into impact VC, then what we need to do is that we need to create or sort of debunk the myth that impact and returns don't go together. One of the ways that Cyril sees that we do this would be risk protection guarantee for private LPs that go into impact. And then a third point that is super interesting from our conversation with Cyril is that the frontiers of impact VC in 10 years might not look like the ones we have today. So, for example, in 10 years, impact VC funds might be investing in civic tech or other categories of impact that we don't really look at today. So, hope you want to listen in, and we're really excited about this.
Here's a few words from our beloved sponsor. Impact VC is a global community of VCs accelerating impact within venture. Their purpose is to cultivate a community and resources to unlock venture capital's ability to tackle the world's most pressing challenges. The community is made up of over 900 VCs, including both pioneers and newcomers, including generalist VCs and impact specialists. Visit impactvc.co to join the community and explore their resources, including the VC Impact Playbook, the Founder Impact Playbook, and the Impact Investing for VCs online training, which is designed to help VCs integrate impact practices into their investment strategies.
That's a lot of information to get in 30 seconds.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
We're super excited for today. I'm joined here by my co-host, Douglas Sloan.
Happy to be here today. Looking forward to the discussion.
Perfect, yeah. And then we have Cyril Gouiffès with us here today. Thank you so much for joining us, Cyril.
Hi, August. Hi, Dougie. I'm very happy to be here with you.
Yeah, I think we're the ones who are truly happy here. We're the ones that are excited to have you.
Yeah.
So you're an LP from the EIF, focusing on the impact VC. So I mean,
that's right.
Super important role you have in the ecosystem by being one of the probably the largest sort of LP in the impact VC ecosystem. So we're super happy that you wanted to join. maybe let's just get running a little bit with maybe your personal story of how you ended up here, and would love to hear some of your journey into Impact VC and how it has changed throughout the years.
And before answering straight to your question, August, also let me stress that it is certainly as equally important to put capital at work for impact companies out there, but it is certainly also very important to make sure impact investing does not remain a bit of a closed topic in a closed community where everybody is fine and agrees within that community, but it's also certainly important to make sure it spreads beyond that community and do a bit of ecumenism, so to say, on the topic. So I'm very happy to be with you today. To your question, that is again, I think, an interesting entry point into the discussion, because we all are human beings, isn't it? And we therefore also have a personal history that leads us to where we are today, and certainly also a bit offers a background and explanation on why we choose to go this or that route, professional route ahead. In my case, I have a bit of an exotic background, I should say. Certainly, when I compare, when I look at my peers in the industry, a background that I fully assume, of course, but I also reckon it is somewhat different. One reason in many is that I never studied finance. I never studied finance as such. So my academic background is in political science and international relations. So what dragged me, if we were to rewind, to explain or understand why am I doing impact today, that certainly has to do with the fact that I felt I always had the privilege of going to university, learning, and also a bit of a touching topics, discovering topics and analysis, and also teachers and also students that have been a significant resource for me to rise, so to say, as a human being, as a citizen. And one of the values that govern also my choices back then and still today is this feeling of fairness. I mean, and justice. It's one thing to have the privilege in the world we live in of having access to higher education, having the infrastructure, the security that allows you to also study and learn. I think that gives a responsibility, so to say. That I always thought that if I could, I would love to be in a professional function that also generates positive impact, or generate, not to use it all of a sudden or straight ahead our jargon, but that would a professional career that would help me also ensure there is some fairness and justice, meaning that working on socially intense or social value-adding thematics was something that was always dear to me. My parents were doctors, so perhaps that's also something that was deep in my DNA from day one. But that was one of the core value in my university or academic journey, and also having quickly the feeling of being part of a broader, it's not just about France, it's not just about Europe, but it's also, we live in a global world. That I was born in 1981, so I think globalization is very close to also the cultural base I've been into. So at the beginning, it started off, with international relationships, and perhaps how I could, with my input, also work on topics such as North-South relationships, economic development. So that was really the governing topics I was studying. That led me to microcredit and microfinance as I specialized, from a fairly generalist political science background into a more specialized one. And microcredit and microfinance was a topic and a tool that I quickly found fascinating for many reasons. While one of them is that it does bring around the table people who perhaps don't know each other, perhaps have some given ideas and cliches one to another. Perhaps a banker would sit next to someone working for an NGO, and then being around the same table. I like this idea because I never thought solutions can be found in isolation, and also very important to not judge someone before even having talked to him or her. So this is one of the things I like in microfinance that actually I also see in impact investing, meaning that there is a conjunction, a combination of know-how, a combination of capacities that all strive to address the most pressing climate social issue. And so this is something I like very much. That's what I think led me to microfinance, perhaps to be more specific. Had a degree degree in political science, went into microfinance, worked for a microfinance institution in Morocco, worked for a microfinance institution in the Near East, in Palestine. At one point, I felt that it would also be certainly meaningful, perhaps even, as a French, male, white, European, I felt, I was perhaps more legitimate to also work on social actions in my turf. I reckon this can sound a little bit controversial, especially nowadays, but I've seen too many being exposed to NGOs. I've seen too many, goodwill and genuine goodwill, altruistic driven intentions that led to actually disasters on the ground. Because I tend to think that you need to live in and know very well the domestic and the local culture to be able to come to effective and properly working cooperation tools, development economics tool. So that's also why I, having started with a very strong focus on emerging countries, also from a personal interest point of view, I have joined the European Investment Fund back in 2008. First to work on microfinance projects for the European Union and learning from emerging economies, from the global south, as we say nowadays, how such tools could also be relevant and value-adding to developed or so-called developed economies, northern economies. And that was a bit of a continuous journey from microfinance, microcredit to impact investing nowadays. And I've been working on in the impact investing space for 10 years now.
The discussion of where you have the most impact and where you feel the most sort of correct in acting, or where you feel like you can actually act, is something I think I at least personally have a lot. And I think sometimes a question in the impact space, because as you say, sometimes the issues that we're solving in more developed economies are maybe not as big or very different, at least, than what you're solving elsewhere. So I think super interesting to get your point. Maybe let's start diving into sort of what you do at EIF, and you just talked about it at the end, right? So the LP role in impact VCs, sort of the EIF and you specifically, you've been a trailblazer as an LP in impact VC for the last decades, at least 10, 15 years. How have you seen the market evolve in these years? And what are sort of the next trends that you're seeing? What are the different changes that are happening now that didn't happen 10 years ago?
Nice words. Thank you, August. I mean, it's true that we've started early. Some started before we did, to be very clear. But we started early at the European Investment Fund. It's true, the first fully dedicated source of funding for impact investing was raised or started implementation back in 2013. So it's been more than a decade, and certainly that gives us, and discussing with our peers, certainly we are wholesalers, so we act as a fund of funds, so we don't do any direct investments. So the proximity of the market, many impact players around us have a better or a closer proximity with the market. What we have is a very strong overview and comprehensive overview of the general European landscape. And that's, I think, also part of our core value add. So to your question, if I were to draw with a large brush, let's say, the landscape of what impact investing was 10, 15 years ago and where it is today, I would say that back then we would see, first of all, considerably fewer impact investors on the market. And considerably, I think, at the time, if I recall correctly, we had our first market analysis and tried to map a little bit our market. That was at the time also including the UK, at the risk of adding to the realm. But let's say the market back in 2013 was certainly, in our understanding, around between 30 to 50 impact managers, 50 being a very high end and being relying on a very broad definition of what impact investing is. 30 would certainly more be the more chemically pure or puristic approaches to impact, if I may say. So that would be the first element. It was very much a niche market, very much a topic that was slightly isolated, including in the VC landscape, in the European venture capital, in the global venture capital community. So two very distinct items. Also, looking a bit more precisely, okay, fewer teams, but who are these teams, or who were these teams, and how did they use to, or did they invest? We were dealing with more generalist funds, meaning an impact fund, because impact was back then also a very particular way of looking at the deal flow, a particular way of looking at an investment strategy and the value add you bring to your company as an impact investor. Had to be very generalist. Generalist meaning, investing in companies active in the education space, in the energy space, in the food space, perhaps, access to healthcare space. Very generalist in terms of economic sectors. On top of being fairly generalist, there were also smaller funds. Smaller because, again, a consequence of the evolution of the market. Back then, you would have access to a lower deal flow, a more reduced deal flow, meaning a sample of available impact companies out there that was much smaller compared to what it is today. So that certainly explained both the generalist element and the smaller fund size element. So that's, again, with a large brush, certainly what were the main characteristics of the impact investing market 10 to 15 years ago. The market has considerably evolved since then.
Actually, just a sub-question as well. So how many funds, impact funds, do you have today? Because now it's at 30, 50 in 2013-ish. How many would you say there are today? And then we'd love sort of the trends as you see going forward.
Disclaimer that coming up to a precise number of how many impact fund managers is there out there in Europe is a tricky question, because I expect you would have a different answer from certainly all the interviewees you have. So I'd rather give you a range, because that always depends. Are you doing 100% impact? Are you doing perhaps majority impact? Are you more social-oriented impact manager or climate-oriented impact manager? But I would say certainly across Europe as in the continent, not the European Union, certainly close to 800 impact fund managers. Certainly a bracket between 800 and 1,000, depending on how strict you are and how loose you define impact investing. But I think in terms of fund managers that are raising and managing private equity funds that have a very explicit dual objective of financial performance and impact performance, that's certainly the sample we are looking at, or the population.
That's a big jump from 2013.
Yes, yeah. But a good sign, obviously, a good sign of a healthy, development and pretty and healthy development. Yes, it's also fair to say that, again, you will certainly recall this, but 10 years ago, impact investing was more, the concern around impact investing was more that it could be a terminology that would scare off LPs, compared to today, where it's rather a bit of a buzzword, which again, I do not despise, because that says something about the development, about what are the achievements of impact fund managers in the past decade. So that's a success in itself, but that's certainly required to be very sharp in your due diligence when it comes to assess the drive for impact and how genuine is the theory of change or impact investment strategy of a fund manager.
And that's it. That's a good bridge into my next question, Cyril. And that increasing prevalence of fund managers across Europe raises this question around how you select the good and the great from that subset. Yeah. And as you were touching on there, elements like their impact theory of change and how that plays out and fits with their thesis and their strategy in different ways can be really powerful, but it can be a really powerful differentiator. But I'm interested in how you define a good impact fund today. And when you're evaluating funds for investment, what makes a truly great fund stand out from a good fund?
I'm afraid I won't be very original on that one, because I would say the team. The team, as in many, if not every single equity investments, especially, if not investments altogether, is the key driver or the key differentiating factor between a good impact fund manager and a bad. So that's, I think, the number one criteria. And why is that? Let me perhaps elaborate a bit further. As I alluded to in the intro, I mean, what we look at in terms of competencies, skills, network available within an impact fund manager is an equally balanced, let's say, investment savvy teams that knows the ins and outs of due diligence, of how to negotiate, of how to source a good company, how to create value on the board of a startup. That is, investing in a startup means having much more responsibility than simply providing cash and financial runway for the company. There's also an element around what is the value you bring sitting on the board of that company. You need to have a very strong balance in a perfect, ideal impact fund manager between being very savvy on the technical side of the business, from sourcing to executing, sitting on the board and exiting an investment. But you also need to be equally savvy and driven to actually support companies that deep inside you feel as an investor will make a change or will contribute to address a social or climate issue at scale. And also that's involves a lot of subjectivity. That involves also a lot of personal appreciation, which in the end leads to a bit of an alchemy, if you wish, in a team. Because in an ideal scenario, you find one person that has 10 years, 15, 20 years track record, investing in startups in the relevant sector, in the relevant geography, plus someone who has a very strong drive for impact, and more than a drive for impact, actually has elaborated a sophisticated and precise theory of change on how she or he will be able to put at work its wealth of investment experience to enable, accelerate a positive impact on the market. Such individuals are very rare. So that means the quality of an impact team is also very much a function of the complementarity of the skill set within the team. And it's not rare to see in an impact team someone who, or one person, two person who have very strong investment track record, relevant in terms of geography, relevant in terms of stage, relevant in terms of sector, and perhaps one person next to the first two partners, another partner that has a very strong network, a very strong skills, competencies, experience on generating positive impact, be it in many different ways. So this also implies that you need to have a very great deal of comfort around the cohesion of that team, because we are talking about, a priori, for a great impact fund to emerge, you need to have a complementary team. That complementary team also needs to be very cohesive, share a vision, share values, and actually sustain them in the long run. Because when you're invested in an impact fund, you're on board for 10 years. As a LP, this is an element that certainly is the entry point, and I would say the most important point of our due diligence. Gauging the drive and sophistication of a team on an impact investment strategy. That's certainly the number one. There are others that I can also briefly touch to really, that you need to have to make sure that you're dealing with a very talented, promising impact fund manager. Obviously, the investment strategy is key. Are you investing early stage, growth stage? What is the portfolio diversification you want to have in your fund? Are we talking about 10 companies, 15, 20, 30 companies? That will also need to resonate well with the stage focus you have. I mean, the earlier you invest, the riskier it is, but also the potentially higher the upside. So you need to factor that into your investment strategy. Next to the investment strategy, you obviously also have the market access. You have the general terms and conditions of your proposal. You have the fund size, your capacity as a team to be able to raise from the financial market up to the fund size, target fund size, and then a series of governance items that need to also be there again, with one sole objective, sustaining impact performance and financial performance for 10 years out of that investment vehicle.
Thanks, Cyril. It's really helpful to understand how you think about that. And lots of that chimes with how we think about fund evaluation at BSC, as you know, from our conversations over the years as well. These elements of balance between the impact skills and the venture skills and complementarity of a team and how that team and firm is set up for the long run. And I wonder if I might just push you on one point, which is around if we're looking for this balance in all of these factors and the alignment between team and strategy and composition and portfolio construction and all of these things, how do you weigh that relative to the need for differentiation in an increasingly crowded impact venture market? And what does the different enough to look exciting feel like versus different enough to look unbalanced feel like in your experience of doing that over the years?
As I was mentioning, the team is the entry point and certainly the most important element for to assess the quality of an impact fund proposal. It is obviously, and of course, not the only one. And certainly the positioning, the investment strategy coupled with the market features that an impact fund manager wants to invest in needs to be complementary and resonate well. So specialization, or let's say the USP of a team, will certainly be checked around based on a couple of items. And the degree of competition on this given sector will be one element to assess how unique this team is and best equipped to address a very focused and specialized strategy. You also need to look at, beyond the capacity in the team, the complementarity of the team competencies. You need to understand well the access to that market. Is there high degree of competition? If so, how likely is this team to be able to access competitive financing rounds when a startup needs to close a Series A, Series B round? There are objective elements to look at to assess, let's say, how unique is a team. But nowadays, I find this question has become more and more strategic and fundamental because having been in the space for 10 years or so or plus, perhaps it's a question that we will dig further later on, but there is a bit of a decorrelation between the social impact space and the climate impact space or green tech space, because more fund managers, more deal flow, and more investors on the climate/green tech side of the impact investing business, which is a good news, obviously. Less so on the social impact space for reasons such as, perception of perhaps a riskier asset class, perception that it's more difficult to monetize in the social innovation space than it is in the green tech space. So in our world and the way our world spins, we need to also develop new financial instruments potentially, but also make sure we give the chance to the right team to make sure climate does not outpace social innovation in such a way that social impact in a few years becomes a history. So this is an evolution we see in the market. And to your question, Dougie, I think we want to work with specialized teams that do bring something unique to the table in terms of helping a company beyond the capital invested to address a particular HR challenge, address a particular replacement of the IT platform type of challenge. Investors out there have gone through these challenges in other sectors, other capacities, and that's always an experience that becomes very useful for the portfolio of such an impact fund manager or GP. What we do is very much at EIF is investing in emerging managers, first-time funds. So this is also what our contribution as a public investor to the market infrastructure, to make sure there is always a variety of approaches to impact. And we do not stick to the definition of impact as it has always been, and that we think it should always be. It's a living entity, impact investing, so to say. So we are keen also to support new teams in markets that are also where there is not necessarily another precedent of impact funds. And so this is how we ensure that we have a proper renewal of the industry and also keep in tune with emerging thematics and and new theme that we see, because that's the point I want to make on this last part of the answer, is that when we started, the vast majority of impact funds, as I was mentioning earlier in your first question, were focused on education, health tech, as far as social innovation is concerned. I'm somewhat eager to also find teams that are using media as an accelerator of social innovation, using culture as an accelerator of social innovation, or using also technology to address some of the challenges that are particularly sharp in Europe around democracy and civic rights. And I'm convinced technology can play a role, provided it is also used or pointed in the right direction with the combined traction from entrepreneurs, like-minded entrepreneurs and like-minded investors.
Something that Dougie and I were talking about before, sort of doing this podcast, was you have a lot of different impact funds in your portfolio. Are there any sort of conclusions you can make already now on sort of the returns of impact VC funds compared to traditional funds, or any specific types of or sectors that are doing better than others, or any data you can share so far?
Yes, we do have, obviously 10 years down the road, we do have learnings on the impact investing space, how it behaves, how it compares with more traditional VC. We've invested. I was looking at in our books before having this our podcast now, and so since we started being an active impact LP, we've invested in we are LP in 140 impact funds. Certainly around 130 today, but by the end of the year will be 140. The December run up, but that corresponds to roughly commitments north of 2.7 billion euros. So that's a substantial contribution that obviously that we're very proud of, but that also helps us nowadays fine-tune our strategy based on the learnings we have from this wealth of portfolio, let's say. And on the correlation, general answer to your question would be that yes, we do see a very strong correlation between financial performance and impact performance in this particular impact portfolio I was just referring to. It is an investment activity. It's an early stage investment activity, so things do not go always as we expect. I mean, that's in the end, venture capital is in many languages also called a risk capital. So that's that's an investment class, that's an investment strategy that involves a high degree of risk. Risk being not being able, as a fund manager, to return the fund to your investor or to meet the success you actually raise your fund for. So I do confirm we have systematically or almost systematically a positive correlation between financial performance and impact performance. We have funds that we already know, impact funds we already know will not be able to return the entirety of the fund to their LPs. It's obviously and thankfully an exception in our portfolio, but these cases do exist. For these cases, what led to the incapacity of the fund manager to return the fund is certainly, as in any investment activity, the investment decision, the targets or the portfolio companies that were eventually invested or supported did not make it to the local, regional, global success that was inside, let's say, for the fund manager when it decided to invest. And in these funds, you often find a positive impact performance. So there are funds for which we do see a decorrelation. Companies, it's an equity business, so companies don't get sold, so the financial value of the fund is decreasing. The companies the assets in the underlying portfolio are decreasing in value. This being said, it has for a certain period provided and generated the positive impact it was after. So it was never, we do not have, thankfully, in our portfolio, some kind of impact mistreatment, but we do see impact failures that are triggered by the fact that those companies have not made it. So the impact is not sustained, so the objectives are not met. Doesn't mean that there is a decorrelation in a way that impact is poor, but financially the company has become a hit and has returned a fund by three times. This we don't see. So the most disappointing stories are in our impact portfolio, or companies, so to say, are companies that certainly had a great impact idea and a great impact thesis, but did not survive the startup phase. What's also important to mention is that after mentioning few exceptions, after mentioning that we generally see a very strong correlation between financial performance and impact performance, what is also true is that we generally see that impact funds, compared to VC peers, take longer to materialize value optics. And this is not always the case, but this is a bit of a pattern because this is in general the case. The reasons for that are manifold. I would perhaps mention two in particular. One is that financing rounds for an impact company tend to be take longer than it is for a pure take-only focused companies that perhaps will raise in the very early growth, provided it's a strong growth, every 12 months, perhaps even shorter than that. In the impact space, it's slightly longer. That would be, again, it's difficult to drop general figures, but an impact company closing 2 rounds in less than 12, 18 months is rare, very rare. It's more generally perhaps somewhere between 24, 36 months in general. So that explains why it's not incapacity to generate value. It's more a value that takes longer to materialize, which also in itself, and perhaps we'll touch about it, question the fundamentals of the impact industry. And again, we've had this conversation many times at Gouiffe. Is a 10-year closed-end fund the most suitable financial product to maximize the impact of a startup? I mean, I don't want to answer that question, but I'm convinced it deserves to be asked. So there is a time element, but the fundamentals of the industry, being more than 10 years in it, remain very strong. And I remain very much convinced that not only it is a relevant investment decision, a smart investment decision to invest in an impact fund or an impact company, but I would also argue that going forward and having in mind the world we live in, the challenges we're facing as a society, it will be harder and harder to justify investing in an asset class that has exclusively a financial target. I would turn the question the other way around, and I would say it would certainly be harder and harder. I'm not naive, and I know the world we live in, so I'm not saying it will be impossible, but you will need to build a very pretty strong narrative to invest in a company, a fund, an asset class in general, with the sole compass of generating short-term values for your stakeholders. That may become a way too risky strategy for us collectively as a society going forward.
And to that point of bringing financial goals and impact goals together and thinking about correlation and thinking about setting up a financial system that can do that effectively in the future, I'd love to talk to you a bit about impact carry. And EIF, but also you personally have been one of the architects of impact carry. You've seen it play out more than any other investor over the last decade. I wonder if you could briefly touch on the thesis for implementing impact carry, so the reasons for having it, but then especially get into some of the lessons learned, some of the challenges, some of the things you've seen sort of happen over the last 10 years in implementing and watching impact carry play out in the ecosystem.
Pretty simple to share why we as EIF and as a team decided to move ahead and become that stable source of funding for European impact fund managers. I recall very much the discussion at the time between EIF and BSC on this particular topic, and we've mutually nurtured our reflection, I believe. But the number one, even before having closing the first investment in the space, we had very strong views around the fact that impact investing cannot afford to be just a fancy terminology to classify an investment strategy. There needed to be more than that. And basically, we always have been of the view that impact investing without careful measurement, but also accountability, would be impact washing. So we felt if we were to set ourselves the goal to become the stable source of funding for impact investing in the next decade, hopefully more, it cannot be that the impact objective that you set to yourself as a fund manager and that you are, by the way, selling to your prospective LPs in the due diligence phase, you cannot afford as a fund manager to just put forward these impact objectives in your investment deck when it comes to raise the fund and forget about these objectives once your fund is raised and your subscription documents signed. So we wanted to find a system that would allow the whole value chain from entrepreneurs to fund manager and fund investors be accountable for the impact that is achieved or not achieved. And this is why very quickly it felt to us that it could not be simply ensured through reporting. We know what happens to reporting, even though you potentially have to disclose very poor figures on your impact performance as a fund manager in your Q3, Q4 or annual report. This is basically it, right? You are displaying bad figures, but consequences are not so clear. Yes, there will be certainly difficult consequences in terms of reputation, but we wanted more. And this is why we came up with this idea of tying the carried interest to not exclusively financial performance, that has to be here anyhow for carried distribution, but also impact performance. I don't know to what level of details we want to enter there, but basically you asked me, Dougie, on the principle. If there is one principle that prevails for us to implement this impact-based carried interest, is the accountability we wanted to create around impact achievement. So that means, in essence, you raise an impact fund, you invest in companies, those companies do super well, you return the fund. As a fund manager, you are entitled for a share of the financial value that has been created. This share will be distributed to you as a fund manager if and only if also impact objectives are met. And it sounded for us like something fundamental. Again, in our capacity as a public investor, if we are to play on the market infrastructure, if we are to play on the so-called goods practices, this was to us one of the very strong safeguards of the industry we wanted to put in place when starting. Perhaps I can also elaborate just a moment saying that when we started presenting this approach to other LPs or discussing it with fund managers that were coming to us to raise an investment, that raised a lot of doubts and a lot of questions. This idea to tie the carried interest to impact performance and not exclusively to financial performance, and to tie the carry to, yes, first and foremost, financial performance, but also impact performance. Because we heard stuff like, yeah, you're playing with the alignment of interest here, so it's dangerous. I mean, perhaps with this mechanism, you de facto, let's say, have the carried interest that you decrease the visibility of the fund manager on its capacity to eventually at one point get the carried interest, which in turn may have very severe and adverse consequences on the success of the fund. And so this is a tricky area you're touching on, and we believe it could turn very counterproductive. Spare you the details, but 10 years or 15 years down the road, it's fair to say that this has become a market practice. Very difficult nowadays to raise an impact fund and say to your prospective LPs that basically carried interest is not subject to impact performance. So this methodology and approach has gone a long way. And second, and that's to me the funniest or the best anecdote on this thematic is that now we see it has become a USP, including in competitive rounds. I have plenty of stories of impact fund managers who have had access to an investment in a startup that was approached by several other VCs, and that entrepreneur decided to have that impact fund manager in the cap table precisely because they knew their interest from an impact perspective would be very aligned, because impact performance would be equally important as the financial growth, the scale and the financial potential of the company if you have this investor on board. And this is something I find pretty enlightening and interesting to see.
Yeah, the competitive dynamics there are really, really interesting. And the sort of reverse audit of company up to VC or VC up to LP about how they think about some of those things. And I think from my perspective with the LP hat on, I would agree it's become increasingly prevalent across Europe for VC funds, particularly those based in continental Europe, to raise with an impact carry structure in place, not least given SFDR sort of pushing folks in that direction from a regulatory perspective as well. But I guess some of the, and I think it's been a really strong success story in that sense. And I think some of the challenges we also hear from VC funds that I'm interested if you hear as well are around appropriate metric setting, appropriate levels of ambition in the targets they're setting against those metrics, ensuring that the LPs that are interrogating whether those are the right targets or whether they are the right metrics are further away from some of the companies at the point that the VC is suggesting that those are the right targets and metrics. So there's a sort of information imbalance. And how have you, I guess there's a range as a consequence in terms of how well people have taken this on board and done it in a more or less sophisticated way. But what are you seeing from the firms that do this well versus the firms that are getting caught up in some of the challenges here? Or what do you see are the challenges that are ones that actually the model might need some tweaks, and how are you thinking about some of those?
To answer your question, I need to go into a bit of detail, but it's true that for this methodology to work, for this approach to work, this accountability around impact approach to work, few elements need to be complied with. First of all, the indicators need to be discussed and defined between the entrepreneur and the investor, not with the fund LP, we believe. Because this is how you get to that level of comfort that the indicator is very intimately linked to the business model of the company, and therefore that makes it easier to monitor and report. But perhaps most important, that makes it more relevant to track and to tie, let's say, your quality success assessment to that particular indicator, because it's an indicator that is fully attributable to the company and on which you have a relatively strong level of control. Therefore, this indicator, you track it, and next to that, it's easier to set a target, and the target, quantifiable target that you set at the moment of the investment on this indicator as an investor in a company needs to embody or needs to correspond to not maximization of the impact, but a validation of the impact thesis. And you can do that if and only if you have an indicator that makes perfect sense with the very core business model of the company. First element. Second, the investor, the fund LP are not involved at that point of the discussion, but they're involved later on. So ex post, LPs are asked to opine, validate, vote on the impact indicator and the impact target. So that's where it becomes tricky indeed. And we are seeing this methodology approach applies across all 140 funds I was alluding to earlier in our conversation, but there are different ways to do it. That's for sure, and we see different practices. So there is no free ride made possible because LPs in the fund are asked to validate the impact scorecard. So it's not as if, you have the fund manager, entrepreneur discussing on their corner, agreeing on a potential impact scorecard, and the LPs having no say, no control whatsoever on that impact scorecard. That's the first element. But it's also fair to say that there is no third-party validation, neither on the indicator and on the target. And this is the case because, again, that has to do with our role as pan-European investor. This is something we cannot ask for. This is something we cannot ask for because we're investing in markets where you would have, the adequate level or critical mass of consultants, of companies who are skilled, sophisticated enough to get to a validation of the impact figures consolidated by a fund, not in every single market. So this is something that cannot be part as requirement of ours, generally speaking, for the pan-European mandate we manage. The principle I mentioned prevail across all funds, but auditing, having a third party validating the figures is something we cannot implement so far. Even if we cannot implement, it doesn't mean we don't like it. We do like it. Actually, we are convinced it makes the scorecard stronger. But again, with one objective in mind is to gain in credibility and in strength for the market as a whole, not simply to tick the box in another EIF process. This is something we don't ask for. This is something we welcome. And whenever we were asked, we're certainly of the opinion that it makes your impact thesis stronger as an impact fund manager to not only have your carry tied to impact performance, but also have all the figures related to your impact performance audited by a third party. Same as you have accountants, you have audited financial statements in a fund. So I'm deeply convinced we are getting there. The base at which we want to get there is the whole question. That could soon become an overkill for a market that is already fragile, I don't know, but certainly it requires a high degree of care to flourish and grow as we expect. So I'm convinced this is where it heads to. I'm not sure today is the right moment to impose that on each and every LPs, or GPs. This being said, I stress again that some funds do it. And some funds do it. The ones who do it, I think, obviously see their USP even stronger. But that's, again, provided you have the right level of competencies on the ground to not only understand your impact approach, but validate your impact approach, because that could also become very detrimental, including in a very sophisticated market where you have plenty of impact fund managers, where you have plenty of impact consultants fit to provide such an audit. That could backfire also very well. If there's a misunderstanding on the impact approach of a fund and suddenly the audit cannot be signed or validated by the consultant or company in question for X or Y or Z reasons, that becomes very much of a blow to the fund manager, including for very genuine impact fund managers. So we need to tread carefully on this topic, but that's certainly one limitation of the system that we see, that is not perfect, was never built to be perfect, but was built from day one to holicize. I'm not too sure it's an English word, not too sure it's a most appropriate word, but to set in stone the drive and value add of impact investing and to avoid impact washing. And I think that, again, if you see, and we touched upon that earlier, if you see the evolution of the market starting from perhaps a handful of 30 fund managers in Europe 10, 15 years ago to perhaps close to 1,000 today, it is all the more important that those who claim or call themselves impact fund managers are genuine impact fund managers indeed. And it's also perhaps just a final word on this particular point. I am personally not too convinced on the labeling policy or, putting a label on the fund allows LPs to basically not do their due diligence and have a full comfort around a fund that is an impact fund and we invest in green. And I'm convinced, mankind being mankind, I am personally convinced that such a label will be, there will be opportunity approaches and it will be perverted in some ways. So I think there is no way around doing a thorough, complete due diligence before making an investment to have the appropriate level of comfort around the impact that will be targeted by the fund manager in question.
But maybe I think there's sort of the GP and the LP perspective in sort of the scorecard discussion and how it fits in. A large reflection as well, as you say, sort of is there's both public LPs, but there's also private LPs. How do we get more of this private LP money into Impact VC? Is scorecard auditing sort of that? Is that one of the ways of doing it? Are there others? So what can really help us get more private LP money into Impact VC?
Again, very good question, August, and I think a super particularly sharp one at the moment that I'll try to answer as best as possible. But yes, on the one hand, I believe this carry mechanism is one element that sets you apart from the crowd, and so gives your LPs, prospective LPs, the very strong degree of comfort around your investment strategy and your impact strategy. This being said, it's only part of the answer, because if you ask any impact fund managers, they will all say perhaps their first issue is fundraising. That's perhaps true. And again, an interesting question also to you at BSC, but I think it's true for all venture capital funds in general. Fundraising is difficult. The current macroeconomic, not to mention the current political environment, is such that equity is less attractive than it used to. So if you add in your strategy not only financial performance in the equity space, but also impact performance, that for a wide variety of LPs would appear as perhaps a risky element. So fundraising in general is difficult. I think it's particularly the case for impact fund managers. This is why we strive to remain a stable source of funding for a sound development of the market. How do we do to get more private LPs in this market? It's difficult. And if you ask me, we don't see them enough. And we would like private LPs to invest more in impact investment funds, in impact startups altogether. There are other ways to do that. I think the role of public investor in this space is pretty crucial. But one way would also, we hear a lot about blended finance, about systemic investing. So certainly having risk, let's say asymmetric risk return profiles in funds could be a relevant and interesting way to catalyze more private funding in funds. That means basically utilizing a source of funding, being public, being perhaps more from a philanthropy side, or that would not have the same risk return expectation than private LPs, with the sole agenda of tapping into the real sources of funding and tapping into the real source of private capital to flow into impact funds. And private LPs would be incentivized to do so because they have a guarantee that there is some kind of risk protection by some shareholders that would take on the potential losses for funds to be able to get to the target and actually attract and catalyze a wider variety of investors. So that's one element we're looking into. Then I think that will call very much for the role of foundations, family offices in the space. Perhaps that could play that role, provided, of course, that will require the impact thesis to be very strong and very reliable, especially if you are in such a fund profile where not all investors are ranked pari passu, and perhaps private investors, commercial investors invest provided they have certain degree of protection against potential losses incurred by impact funds. This is one way of looking at it, or perhaps one solution to attract more private capital in the space. I think generally also we have to question the fundamentals and basically continue to demonstrate, as we strive to do, that there is this positive correlation between impact performance and financial performance. I'm not saying there is no trade-off between financial performance and impact performance, but I'm saying that what we're seeing, that there is a positive correlation between the two. So provided your agenda as an investor is to maximize impact, preserve your capital, nurture, eventually get also a financial premium on top, then impact investing seems to be a very relevant strategy to invest in that reconciles both doing good and doing well. So there are doors that we have not pushed enough for, that leaves a hope for to catalyze more private sources of capital into the space. But it is difficult. Let's be honest and let's face it, the current environment, it is difficult. That's, again, also sort of implies or involves a very strong constance, and public investors being constant and still keeping their trust and faith in these strategies, so that over time and eventually, potentially long after we are retired, proof has been made that this is an impact, this is an asset class or a strategy that makes sense and actually deserves attention, especially more than the others, perhaps more than the others in the current world we live in.
And that reflection of yours around fundraising at the moment being challenging, I think, is one that we'd echo in what we see at BSC, but for impact funds, but also for the general VC market, I think is challenging at the moment. I saw a statistic the other day that there were more VC funds in market now than there have ever been in terms of the cycle, the growth in VC, but also where we're at in the fundraising cycle and post the sort of froth of a couple of years ago. Funds perhaps coming back to market now and finding there's less capital to compete for, and there are more people competing for it. So there's this historically high point of competition. And I think your points there around the structural innovations that people can make, or the fundamental points of evidence people can build around their fundraising, I think is really powerful. But I wonder, apropos of that, what your fundraising tip for impact VCs would be, building on those suggestions and maybe getting into more of the maybe the fundamentals as well, but also maybe more the tactics and the positioning and the storytelling, and how you think Impact VC can best do that in the current environment?
First of all, the what will plead or what will be the most powerful, most convincing element for LPs to invest in a fund is your track record as a fund manager, meaning what you've been able in the past to do, close as an investment, and what kind of performance you've been able to generate across cycles, up cycles, down cycles. I mean, in the last decade, obviously, we have had our fair share of up cycles and down cycles. So the track record is certainly the element that will be decisive to be able to raise. And certainly, this is not a tip, obviously, but this is just to confirm that this is one entry point that will be always looked at with the highest degree of care by any LPs. Then, and I would get back here to the accountability point we discussed earlier, I believe that your capacity towards your LPs to be faithful to your investment thesis and to demonstrate that you have a privileged access to impact companies or to invest in companies that are always after, yes, scaling potentially regional or global champion, but scaling it provided you always grow on the back of solving a social or climate issue is a very important element. And in the end, again, your track record will be your most convincing argument always. I think that next to this, and to your question, Dougie, there are certain pillars of the social innovation space that needs to be put forward as, sectors that yield very significant or socially climate intense solution, such as, education in the social space, energy in the climate space. Being active on these sectors will, next to a very strong experience and track record, will always prove or provide for very convincing argument that you can run your investment activity in a very sound / financially profitable manner, next to demonstrate your capacity to generate very tangible social impact, climate impact. That would be the second element I mentioned. The third element I would mention is also, and that's just a topic that is particularly close to my heart, is get back to, if you wish, the pioneer cell of the early years. Meaning impact investors are investors who invest in stuff that the others did not invest in before. And again, that's also, I reckon, perhaps a bias with my microfinance background. I mean, that's also the most general definition of microfinance you will ever find out there, that prevails from the suburbs of London to the suburbs of Dhaka, is invest or lend to clients to whom nobody else is lending. And I think that remains a very core important element of impact investing. Because thematics such as the one I was referring to earlier are thematics perhaps around in the online arm, around civic tech, around media, around culture, that are not invested enough by traditional players, so to say, or by market players, such as impact investors. Those areas are areas that are full of potential in terms of combining potential scale, commercial success, with very tangible, positive social impact. And I sometimes, and again, I don't want to send any generalities that in itself are wrong. A generality cannot be true, but I sometimes wish that impact investors in general get back to this wave of pushing doors that have not been pushed by anyone else before, and perhaps again the backpack and the pilgrim stick, and go on thematics that nobody invested. While perhaps the model is not proven, perhaps it's risky, yes. But there is a very strong consensus that such areas can yield very positive, immediate, tangible social climate impact. That's one of the things I would wish to see more going forward. And again, just to close on that question, thematics have always evolved. Again, you were mentioning impact investing 10, 15 years ago. You would see LPs looking at you like wondering if you're, not slightly crazy or crazy or lunatic. Back then, the gender thematic was not as much as big as it is today, as important as it is today. thematics are evolving. The climate thematics were not 15 years ago. They were already out there, and we know about clean tech, and we know how it evolved, etc. But they were not as systematic as in these are urgent sectors we need to invest in if we don't want to end up in a planet that we cannot live in or live on. Always be very mindful that the thematics that are important today will not be the ones that are important tomorrow. Or let's say there will be others next to these important thematics of the day. This would be certainly one of the things I would hope for our ecosystem.
Cyril, I actually think that's a perfect way to round it off a little bit, because you just gave us some of the key tips for potential new impact VCs that could start, or traditional VCs that could find a new way into impact. So maybe let's round it up there. And I would like to say thank you so much for joining today. It was super interesting to hear everything, both from sort of how do you protect the risk for a new private LP, what are the new trends, what are the new things you should look into in impact VC. So yeah, so thank you so much for joining.
Thank you, August. Thank you for mentioning again. Said it at the beginning. I'm happy I can confirm it at the end. It was a real pleasure. And hats off also to your initiative that are very important for our market and ecosystem as a whole. So thank you very much.
Thank you very much, Cyril. Great to speak as always, and I appreciate you taking the time.
Here's a few words from our beloved sponsor. Impact VC is a global community of VCs accelerating impact within venture. Their purpose is to cultivate a community and resources to unlock venture capital's ability to tackle the world's most pressing challenges. The community is made up of over 900 VCs, including both pioneers and newcomers, including generalist VCs and impact specialists. Visit impactvc.co to join the community and explore their resources, including the VC Impact Playbook, the Founder Impact Playbook, and the Impact Investing for VCs online training, which is designed to help VCs integrate impact practices into their investment strategies.
That's a lot of information to get in 30 seconds.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.